Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone, and welcome to Accredited Investor Markets Radio. This is your host, Christopher Cahill. Later on, Alicia Purdy will interview Peter Renton about peer-to-peer lending. But first, let's talk about sin. Yes, sin. Legal sin. There's money in sin. At least that's the subtitle of a Telegraph article dated February 4th, 2015. Face Facts. There's Money in Sin by Tom Stevenson. So sinful things, fun stuff, booze, gaming, gambling, pornography. First, the article writer tells us why investing in sin should pay structurally. Well, as he puts it, where there's steady demand, and God knows, and God would know that there's steady demand in booze, gambling, guns, and porn, and that these businesses tend to be high margin, and that there tend to be high barriers to entry in businesses that might be regarded as dodgy or sinful. And another, actually even more telling point to me, is that there are a number of investors out there who have a bias toward ethical investment. That is, they do not want to invest in sin. Well, to the extent that any significant number of potential investors is avoiding sin investments, then the price for such investments will be structurally less than the value of such investments. Well, the author reports that a fund called the Vice Fund from 2002 to 2015 returned $3.37 for each dollar invested in 2002, while a different fund, the Vanguard FTSE Social Index Fund, an ethical investment fund, from 2002 to 2015, a dollar turned into $2.68. $3.37 is quite an improvement over $2.68 on a per dollar basis. Finally, the article makes the point that tobacco underperformed the market through the mid-60s. So in the Mad Men era, when tobacco wasn't considered to be sinful, tobacco did not do as well as the market. But since the Mad Men era, since tobacco has become considered to be sinful, and those who smoke considered to be outcasts, tobacco has generally outperformed the market, consistent with the thesis advanced earlier in the article that some investors do shun sinful investments. So sin pays. Well, let us extend the concept of sin way beyond its normal bounds and consider it to include fish carnality. So let's talk about salmon milt, M-I-L-T. It's another word for salmon sperm, specifically the DNA within salmon milt. It may present a very good investment opportunity as well as an ethical investment opportunity. It turns out that salmon milt may be a key ingredient for extracting and recycling rare earth elements. Now, it's been tested with regard to certain magnets, but maybe it can be applied to ore and even most sort of attractively to electronic waste to extract the rare earth elements from that without using a less ecologically friendly technology. So Japanese researchers created milt powder, put it in solution with a neodymium magnet, which contains rare earth elements, found that the metal ions have a high affinity for the phosphate in the milt powder. So once the ions have become attracted to the phosphate, the rare earth elements can be recovered from the milt powder using acid and centrifugation. So a Japanese team developed the process. Jean-Claude Boonsley of the Swiss Federal Institute of Technology has concluded that the process deserves attention. And mind you, thousands of tons of salmon milt are discarded by the Japanese fishing industry every year, to say nothing of the American fishing industry and other fishing industries. All the salmon milt being sent into the waves to liberate rare earth elements along the ocean and presumably the ocean floor. Not all is bright and sunny always for sin. I'd like to talk about a dark cloud that was summoned in recent years and then recently dissipated in terms of government overreach. And that dark cloud is called Operation Choke Point. Operation Choke Point was the United States Department of Justice initiative begun in 2013, ostensibly to investigate banks doing business with companies believed to present a high risk of fraud. Well, that sounds all right. Ultimately, though, Operation Choke Point was found to be a means of pressuring banks to cut off access to banking services to certain businesses without a finding of any violation of any law, let alone a prosecution. The categories of businesses exposed to this Operation Choke Point included payment processors, payday lenders, gun dealers, coin dealers, pornographers, tobacco sales, and head shops. The operation was uncovered by the Wall Street Journal in an August 2013 report in its pages. On May 29, 2014, the United States House of Representatives Committee on Oversight and Government Reform issued its report, which savaged Operation Choke Point, stating that it, quote, inappropriately demands that bankers act as the moral arbiters and policemen of the commercial world, end quote. The FDIC and Department of Justice have both launched investigations into Operation Choke Point. And on January 29th of this year, 2015, the FDIC issued a statement, and the statement reads as follows. The Federal Deposit Insurance Corporation has issued a financial institution letter today encouraging supervised institutions to take a risk-based approach to customer relationships rather than declining to provide banking services to entire categories of customers without regard to an individual customer or the financial institution's ability to manage the risk. And that sounds like an admission. I'll direct you briefly to a publication called The Daily Signal, which is put out by the Heritage Foundation. Now, the Heritage Foundation has a set of conservative points of view. They're no friend of regulation in general. But for what it's worth, the article is entitled Meat for Business Owners Squeezed by Operation Choke Point, and it's dated August 12, 2014 by Kelsey Harkness, and it describes 4 specific business owners: a payment processor, one who issued loans based upon auto titles, a pawn shop operator, and a sporting goods store owner. The sporting goods store sold guns, each of whom was cut off by their financial institutions under pressure from the Department of Justice and the FDIC under Operation Choke Point. So, in summary, first, sin pays as an investment. Second, fish carnality may prove to be an ecologically virtuous means of recycling rare earth elements. Third, the U.S. government is capable of serious killjoy policy, enlisting regulated entities to deny basic services to legal but sinful businesses, which just tells us that the price of the right to transact in legal sin is eternal vigilance. Now let's get to the interview.
Thanks, Chris. I'm Accredited Investor Markets Managing Editor Alicia Purdy. I'm speaking today with Peter Renton, the founder of Lend Academy. Lend Academy is the leading resource for the P2P, that's peer-to-peer lending industry since 2010. Peter is also the co-founder of Lendit, the leading industry conference, as well as Lend Academy Investments, an investment management firm focused on the peer-to-peer lending asset class. Welcome, Peter.
Thanks, Alicia.
Let's launch right into our discussion. We're talking today about peer-to-peer lending. It's a type of investment that may be new to many in our audience, so we'll begin right there. What is peer-to-peer lending in a nutshell?
So peer-to-peer lending is something that's actually been around for centuries. It's just simply connecting people who want to borrow money with people who have money to lend. Now, what's happened in the last decade is that this concept has been brought online. So now people can connect with other people online in a safe and secure way. And it's even extending beyond that now, where you have a mix of individuals and small businesses borrowing money and connecting with investors who are individuals and also professional investors, institutional investors, hedge funds, even insurance companies, those kinds of investors. So they're all coming together through these online platforms.
Okay. Peer-to-peer lending, as you said, in one form or another has been around for a very long time. And you've noted that since it's gone online, peer-to-peer, P2P, is a win-win. And I had read that on the Lend Academy website, which is a great resource for information on peer-to-peer. A win-win, which sometimes raises red flags for people. So you can explain, if you would, to our audience, who wins in a P2P situation? How do they win? What does that mean?
Sure. Well, there's two sides, as I said, to the peer-to-peer lending equation. There is the borrower side and the investor side. So let's take the borrowers first. Borrowers are able to obtain loans at a lower interest rate than they can through their credit card or through a bank on average. And so that's a real easy win for the borrower. They're also able to apply for a loan at 2 a.m. in the morning in their pajamas. They can get an instant response to find out whether they have been approved or not. You don't have to sit around waiting for several days or even weeks. And you can have your money in your bank account very, very quickly. So so it's speed, it's ease of use, and it's lower cost. That's the wins for the borrower. Now, on the investor side, it's also a major win because, investors are struggling to a decent return on their investments today. I mean, if you take your money out of the stock market, which a lot of people did in the last crisis, and you put it into fixed income, that has performed very poorly over, the interest rates are very low for CDs, for bonds, for any kind of money market account. That people that, particularly retirees, people who have been used to living off fixed income, suddenly have found that their income has shrunk by 80% or 90% in some cases, and so these people have needed another way to increase their income. And peer-to-peer lending provides that opportunity. The typical returns are in the high single digits, so that's certainly well above inflation, and that allows for a good return for just about anybody.
Now, just a side note, for the borrower, and we speak exclusively with investors, but out of curiosity, most of us have probably been borrowers at one time or another. Are interest rates comparable, better or worse, to the interest rate you might get from a bank? And certainly, I'm sure it's better than, the cash check store down the street. But what is it like in compared to the other major ways that people go and acquire money when they need it?
Okay, so banks, obviously are still lending, billions of dollars every month, and if it's backed by real estate, then those rates are fantastic. 30-year fixed mortgage, you're not going to get peer-to-peer lending competing in that kind of product anytime soon. For the most part, there are exceptions, but so real estate, and even a home equity line of credit, that's going to be less expensive for the borrower as a rule than going to one of these peer-to-peer lending platforms. But just getting a personal loan from a bank, an unsecured personal loan, is actually very difficult to do these days. There are not many banks that will lend you $25,000 and have you be able to do it with what you will. That kind of lending really was, a lot of banks just shut down their personal loan business completely after 2008, 2009, and they haven't opened them back up. So most people are left with the perennial kind of product for lending, which is a credit card. Now, I use credit cards every day. I think they're an excellent tool, but they're not a great product for borrowing money. They are high interest, and basically if you have a very high credit score, you pay the same as someone with a lower credit score. So that's the sort of thing, and the average credit card interest rate is well north of 15%, whereas the average loan on these platforms is less than that. Particularly if you're looking at 3-year loans, you're looking at about 12%, so several percentage points less than a credit card. There are obviously other opportunities for borrowers, and if you can find something cheaper, I always tell borrowers, then go for it. But I think for the majority of people who don't own real estate, peer-to-peer lending loan is really the best option.
Okay, so I'm going to ask now from the perspective of the investor, and I'm sure there are myriad questions I could ask. But what I want to ask is there a minimum that you can allow someone to borrow? Can you let someone borrow $500? I mean, can you really get just your toe wet, or is it something that you really have to jump in with both feet and say, here's a very large sum of money, and just like any other investment, I'm going to wait it out and see if I get a return? Or can you say, I'm a little skittish, I only want to see if I get a return on my $500, for example?
So the main platforms in this industry in the US are Lending Club and Prosper. Both of these platforms have a minimum investment of $25. So you can just really get your toes wet with quite a small investment. Now, having said that, I recommend people don't put in $25, don't even put in $500. But if you really want to give this a try, you should put in, I think, a minimum of $2,500 and preferably $5,000. The reason being is you want to diversify your investment. That's the number one rule, and really the number one mistake I see new investors make is that they get excited. They might even put in $5,000 and they start looking for loans on the platform and they go, wow, these are great. I'm going to lend $500 to this person, $1,000 to this person, and then they've got a portfolio of 7 loans. And suddenly someone might lose their job, might have a medical problem that causes them severe financial hardship, and they can't pay their loan back, and boom, one of those 7 loans has just defaulted and you've lost potentially 10 or 20% of your investment. That's hard to recover from. What's better is if you have $2,500, so the minimum investment per loan is also $25, so you can invest in 100 different loans. That way, if someone defaults right off the bat, then you only lose 1% of your investment. It's not just for the wealthy, this kind of investment. There's a lot. I mean, I see a lot of students, a lot of young people investing where they've got a small portfolio and they would like to add to it, and they reinvest. But you can get started in a small way.
Okay. You mentioned Lending Club and Prosper, and I want to just cover those for a second. Then we're going to talk about default a little bit later on. These are the 2 biggest names. What are they? They're not considered banks. And if they're not, what are the rules, regulations, laws that govern these type of platforms, if there are any at this point, because it's relatively new?
Yes, so that's a really good question, Alicia, because they are not banks. They are lenders. They have lending licenses, but they don't operate as banks. They're alternative lenders. Now, having said that, they partner with a bank to actually originate a loan. So what will happen is when investors come and invest in a loan, and sometimes a loan will have 1 investor, sometimes it will have 500 investors. So however many investors it has, once that loan's fully funded, then a bank, a partner of Lending Club and Prosper, will actually originate the loan. This is a bank that has a banking license and is obviously regulated by the CFPB and other entities that control the banking system. Right? There's all sorts of acronyms that we can go on. I won't bother going through all of them now, but banks are heavily regulated in this country. And so these loans are originated by banks, and then they are assigned back to Lending Club and Prosper, and basically the loans are put on Lending Club and Prosper's books, and the investors have each of them have a piece of those loans. So, some people say, well, they're really operating as banks. Maybe they should have a banking license. That's not how the regulators have seen it to date. Now, who knows what the future holds once this industry gets very, very large. Maybe they will revisit the regulations. But on the borrower side, they have to adhere to all kinds of federal regulations. I think someone said one time, I think there was 12 different regulations on the borrower side that these platforms have to adhere to. And on the investor side, it's really mainly the SEC that is regulating the investors. And, that's all of the loans that you actually invest in as an investor are securities. So these are securities that are registered with the SEC, and so they have to adhere to all of those regulations.
So then would it be accurate to say that the loans are secured when we talk about for the purposes of banking? Are they secured or unsecured loans?
No, they are securities, but they are unsecured.
Okay.
They are unsecured securities. So really when if one of these companies were to go bankrupt, they have protections in place, obviously, in the event of that, the unlikely event that happens. But they're not backed by assets. you're not going to be able to, there's no recourse for the investor other than through the platforms.
Okay, so there's no FDIC that will give you my money back if there's an issue.
That is correct. That's a very important point to note for all investors. These are, if the borrower defaults, even if the platform going bankrupt is very highly unlikely these days. Obviously, always possible, but what's more likely are the borrowers. There will be borrowers that default, and sometimes you can be unlucky, but that's why it's very important, as I said, to diversify among as many borrowers as possible. And I personally am invested in several thousand borrowers because I want to be as diversified as possible.
Well, now let's talk about default for a moment. What happens when someone can't pay back their loan? Are there repercussions for the borrower? Does the investor get to go after them? Are there safeguards in place to ensure that the borrower can pay it back? I mean, do they have collateral? How does that work?
Right. So again, these are unsecured loans, so there is no collateral held by the borrower. The only leverage the platforms have with the borrower is really their credit score. That's and their good name, of course, although it is all anonymous. So what happens when a borrower goes late is that the platforms have in-house collections teams that will go out and really try and contact the borrower and work out some kind of solution. If they can't work it out, sometimes they'll then pass the loan over to a collection agency that will then continue to work that loan. But there is really no recourse. Now, having said that, the borrowers on these platforms, they have very good credit ratings, very good credit scores, and are what we would call prime or near prime borrowers. The minimum FICO, we're looking at Lending Club, is 660, a Prosper is 640, and those, they're certainly not subprime borrowers. So if you are a borrower and you have very mediocre credit, you simply will not be approved for a loan. And that's one thing that's also important to note, that the vast majority of people who apply for a loan at these platforms are rejected because their credit is not good enough. So if you've gone around and if you're a borrower and you've gone and shopped for credit in various different places and you come along to Lending Club and Prosper, and even if you have a credit score that's higher than 660, you might be rejected anyway, because if you've been shopping around for a lot of credit, that may deem you to be high risk and they will reject you. So the underwriting is very sophisticated at these platforms. The teams that run the underwriting, I'm very impressed with. While there are obviously still defaults, for the most part, you can be pretty sure that if you have a diversified portfolio, then your money is relatively safe, and you're certainly getting, for a risk-adjusted return. I always argue it is excellent, because this is an asset class that has proven decade after decade to be very resilient and provide excellent returns to investors. Just look at the credit card industry; it's extremely profitable and has produced positive returns for banks for many decades.
Let's switch gears for just a second and talk about investment horizon. That's something that everybody is always really interested in. What is an investment horizon like when you're doing peer-to-peer lending? Is it, we know that, private equity can take sometimes a decade, sometimes more. Venture capital might be shorter, but it's higher risk. What is an investment horizon like time-wise in peer-to-peer lending, sort of as an average?
Sure. So that's another really good question. It's important for all investors to go in this with their eyes wide open. So the loans on Lending Club and Prosper are 3-year or 5-year, and it's a fixed interest rates, fixed loan term, and they're fully amortizing loans. And what that means is that you're paying off principal and interest every month. So you, as a borrower, you take out a 3-year loan, and you start paying, 30 days after you've taken that money, you start paying it back. So from the investor side, then you start to earn money pretty quick. It's not like a CD. It's not like a bond where you're earning interest twice a year and then you get paid back your principal at maturity. This is not how it works at all. You are getting paid back principal and interest every month. So, whereas if this is not a short-term investment, if you need your money, you might need the money in 6 months or 12 months, then I always recommend people to go elsewhere. This is something that really is best for a longer time horizon, ideally 3 or 5 years or even longer, because you want to be able to have these high yields compound, so you can generate the best return for yourself. So I think having it that way, having a longer term time horizon, is ideal, and that you are going to start getting money back on a monthly basis.
So in terms of liquidity, it's semi-liquid in that you start to get money back right away that you can keep and use. However, it's not the full amount up front.
Correct. And now I should point out there is also a secondary market for these securities. They are traded actively. And so if you did have an emergency that came up and you needed to get out of these loans, there is a way to offload them. Now, typically, if you have a few late loans in your portfolio, which pretty much everyone does that have been investing for any length of time, you're not going to be able to offload that anywhere near face value. You might, if you've got a loan that's 60 days late, you might only get 10 cents on the dollar for that particular loan. But if you have a good pool of current loans, then you can typically break even or even possibly make a very small profit on those loans. But overall, you're going to lose money because you're going to have some late loans, and offloading those, that's where you're going to have some losses. So, there are ways to become liquid and get your cash back, but ideally people should have a longer time horizon, in my opinion.
Would you take a moment and talk to our listeners about Lend Academy that you founded, what inspired it, what its mission is, and how it helps raise awareness with peer-to-peer lending?
Sure. Well, I started investing personally back in 2009, and I instantly kind of fell in love with this, with the whole idea of peer-to-peer lending, and so I continued to invest personally for over a year, and then an opportunity came up, and I decided this is something that I could really sink my teeth into, and I started to write about it just as a blogger. I wrote about it full time, and really I felt like this industry had great potential. I wanted to be part of it, so I wasn't making a whole lot of money back then of it, but I really believed in its future. And then it was a couple of years ago that I was approached to run a conference, and that's called the Lend It conference. I'm one of the co-founders of that conference. That is something that is a profitable entity, and that's something that I spend a lot of my time on today. And then I also have a third rung, or a third leg of the stool, so to speak, and that is an investment management firm, Lend Academy Investments, which basically is anyone who doesn't want to manage their money themselves, but they like the idea of peer-to-peer lending. We will take on that, and we'll help manage their money either as an individual account, or we also have a private fund for accredited investors, and that's something that we launched earlier in 2014, and it's we're getting some nice traction there. But the mission really for Lend Academy is we really want to educate and connect and help people get access to this asset class.
One of the things I noticed on Lend Academy is that you were very transparent about your returns from Lending Club and Prosper in your investments. Mm-hmm. And I thought that was really refreshing, to be honest with you, going so far as to post them on the website. I did read something that you said where you said, quote, "I adhere to an aggressive strategy that includes plenty of the higher risk loans, which leads to many defaults," end quote. And you noted that most people are not necessarily willing to take that on. Why are you so aggressive? What's the benefit there? And why would someone be hesitant seeing that there's been such success? Sure.
Well, I should point out too, when I first started investing, I invested in a very conservative way. Like many people, I was skeptical. I felt like, come on, you're lending money to complete strangers online. There's no asset backing these loans. There's no recourse for you as an investor. How on earth is this going to work?
It makes sense.
I just invested in the least risky borrowers, and earned a low to mid single digit return, which I thought was fine at the time. But as I studied the space more and more, I came to realize that the best returns in today's economic environment are in the higher risk loans. Now, the reason I say it's not suitable for everybody, because in some ways I'm taking a punt on the economy and the economic outlook, and if something happens and we get another financial crisis, I am going in fully aware that my returns will probably lag the averages if we have another financial crisis, because the highest risk borrowers are going to default at a much higher rate than the lower risk borrowers. And so what I'm doing is I feel like, I'm rewarded really well for taking those risks, and I am prepared to endure a much higher default rate in the event of another economic downturn. Not everyone wants to do that. Some people want to have very consistent returns. I have friends that really only want to invest in A-grade loans, and they are happy with a 3.5% return, and they, those sort of returns, those sort of borrowers will not be impacted nearly as much in an economic downturn as the borrowers that I invest in.
So we've covered a little bit of diversity, and I'd like you to expound on that more. We've covered what default looks like and the investment threshold. What are some of the things that investors should be aware of, including how to diversify and any outstanding issues that we haven't covered so far? Sure.
So as I said, diversification is really the most important thing to remember when investing in this asset class. And how you do it, basically, I always say for an individual investor, if you're putting in $5,000 or $10,000, then make sure you adhere to the $25 minimum investment. That's the best way to make sure you're fully diversified. Now, if you're an accredited investor and you want to invest in a fund, there are many options, including my own fund, and that we do the diversification for you in those instances. Now, I know some people who like to invest across multiple funds with slightly different characteristics, and that's totally fine as well. But the most important thing, as I said, if you really want to diversify fully, and I don't adhere to this, you really should diversify across risk grades, and I stick to the highest risk grades. Now, to be fully diversified, I really should have the lowest risk grades in there as well. But I do it because I'm trying to get the highest return possible, and I'm willing to take on that risk. But a fully diversified investor will be invested across all risk levels.
That makes sense. I was curious because there might not be different types, but there really are across the grade, so you can have high risk, low risk, just like you would anywhere else.
Exactly. And the lowest risk loans are for those people who don't have as much of a higher tolerance for risk, because those loans, and there's lots of history here. We really need to point out that all of the loan history is publicly available from both these platforms. You can go to a site like nickelsteamroller.com, where they provide a front end to inquire on the entire loan history. Or alternatively, if you're an Excel guru, you can download the CSV files and play around with them yourself in Excel. But the entire loan history is available, and you can see for yourself that A-grade loans, year after year after year after year, have an extremely low default rate.
You've noted that getting started in peer-to-peer lending can be confusing or complex for the uninitiated, and I am one of the uninitiated, and I was reading through Lend Academy, and I was looking at all these numbers, and I was trying to make sense of the grading, etc., and I was thinking my brain was starting to smoke, and I thought, okay, we need to find out what are some of the things that are going to be the most confusing that investors should sort of study to understand, like on Lend Academy, before they move ahead. What are some of those basics that they really should at least have a good grasp on when peer-to-peer lending is an option?
Sure. So one thing, when you are an investor in peer-to-peer lending, you are essentially a bank officer. That's the role you're playing. You are giving credit out to borrowers. And now, while these platforms have done a lot of it, they've done the background checks, and they've done, they've determined that these borrowers are creditworthy, it's still on you. And so where a lot of investors get overwhelmed is they go onto the platform, they start looking through the loan descriptions and all the loan details one by one, and there is a ton of information in there. There's obviously, you've got credit score, the FICO score, you've got things like debt to income ratio, DTI, you've got public inquiry, you've got public records, you've got number of inquiries, and all these terms that no one's ever heard of before. I never had when I started looking at it, and it's very easy to think, well, oh my God, how am I going to make sense of this? I don't know what's good and what's bad. I feel like that, then they sort of throw up their hands and give up sometimes. So So I always recommend people, if you're serious, do a little bit of homework. There's certainly some introductory articles on Lend Academy that can help. I also have a simple email series that you can sign up for that takes you through all of the basics, and after that series you really will be able to invest in with confidence. But the more education you can do, the better you are going to be able to make decisions, and good decisions leads to higher returns.
I want to close with one more question. Before we started the interview, you and I were talking about individual investors and institutional investors. Who's the typical investor today, and how has that changed? And is it affecting accredited investors as the space changes, positively, negatively?
So the average investor, when I first started investing, which was in 2009, were basically early adopters, people who were relatively open to new ideas and new investments, and they. There was all individuals. There was no hedge funds, no institutional investors whatsoever back then. Now, fast forward to 2014, and there are still tens of thousands of individual investors, and that number is growing every single day. But there are also now lots and lots of institutional investors, and the balance has shifted completely. And now you're looking at probably 75% of the maybe even more of the dollar volume is going to institutional investors, and what that's doing to the individual investor. There've been a lot of changes to accommodate these large investors, but both platforms are going out of their way to still make loans available to individual investors. Both platforms believe wholeheartedly in supporting these kinds of investors. Now, as an accredited investor, you have options. You can go and invest directly with the platforms. You don't have to worry. There's no accreditation. If you're in an approved state, we should also mention that the Lend Club and Prosper are not approved in every single state. There's only about 28 to 30 states that they're approved in. Some large states such as Texas, New Jersey, Ohio, Pennsylvania, they're not approved. So if you're an accredited investor in those states, you can still invest. You can invest particularly through a third-party fund. That's the best. There's more than 20 funds out there now. You can do that. Lending Club also has a program for very large investors with a high minimum. I think it's like $500,000 minimum. They have their own fund that you can invest in. But accredited investors today, whereas before accredited investors were really on the same playing field as non-accredited investors, whereas today I think this is a very good time for accredited investors to get involved, because there are so many options now available to invest in this asset class.
On that note, we're going to close. I appreciate you taking the time talking to me today, Peter. I appreciate our discussion. I had said to you earlier that if you can educate me, then I think you can educate probably anybody on peer-to-peer lending, and I found it really enlightening and interesting. So thank you.
You're welcome, Alicia. Thank you.
Our listeners can go to lendacademy.com to learn more about peer-to-peer lending and Peter Renton and all that he does there. You've been listening to Accredited Investor Markets Radio. I'm your host, Alicia Purdy, and we'll talk soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.